Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. And today it's all about Nvidia. After the close in New York, the company delivered a bullish forecast for revenue in the current quarter. This seemed to reassure the market that spending on artificial intelligence computing remains strong. Now, heading into this report, analysts questioned whether supply constraints, as well as a shift to the latest GPU design, Blackwell, would slow growth for Nvidia. Blackwell, you see, is a more sophisticated GPU. It's had some manufacturing challenges. And then on the earnings call, CEO Jensen Huang gave an upbeat view on Blackwell.
Blackwell is going to be incredible across the board. And when you have a data center that allows you to configure and use your data center based on, are you doing more pre-training now, post-training now, or scaling out your inference, our architecture is fungible and easy to use in all of those different ways.
Jensen Huang there, the CEO of Nvidia. For a little more on the Nvidia story, we turn to Angelo Zino. Angelo is the Vice President of Equity Research at CFRA. Angelo, it's always a pleasure to have a chance to visit with you on Nvidia earnings day. What did you make of the latest results?
We were actually pretty optimistic about the results. So, overall, when we kind of think about the actual numbers that were posted, numbers implied, or we saw top line growth of about 78%. And that was slightly better than expected. The implied kind of April quarter number of revenue figure of 43 billion, which is kind of what everybody was eyeing, was that April quarter guidance. Consensus was looking at 42 billion. So they got it about $1 billion above the street. Again, it implies a fairly kind of robust growth pace of north of 60% on a year-over-year basis. And, at the end of the day, I think kind of going into the numbers, there was some concern about the Blackwell ramp out there. And when you kind of look at maybe what the most important data point out there was that NVIDIA provided, it was the 11 billion in Blackwell revenue in the January quarter. We were looking for something closer to 7 to 9 billion. And that number is going to accelerate here over the next couple of quarters. And that improved visibility, the lack of the easing of some of the supply constraints out there, I think eased some of the concerns that may have been out there for some NVIDIA investors.
I think it's fair to say that one concern for the current quarter may have been gross margin. NVIDIA is predicting non-GAAP gross margin of around 71%. That seems pretty high, but it was less than forecast. Are you concerned at all about that figure?
Yeah, I mean, the gross margin number was probably the one black eye as far as where we kind of were looking at the guidance side of things. It was definitely a disappointment. I think when you kind of especially look at the trajectory of gross margins over the last couple of quarters, it kind of hit a peak run rate of about 78% in the first half of calendar 2024. So the margins continue to compress here going into the April quarter. The good news is we do expect that to essentially be the trough of the cycle here in the April quarter. And then what we do expect is an improvement on the margin side of things. The company a couple of months ago did guide to the fact that as Blackwell ramps, you are going to see margin pressures. That's what you're seeing now. The company reiterated the fact that they expect mid-70s margins as we kind of go into the second half of calendar 2025. And the fact that they did reiterate that, I think kind of is allowing some investors out there to at least look past some of the disappointment on the margin side of things.
NVIDIA stock is still below the pre-DeepSeek level, and I'm wondering whether or not this has changed. The DeepSeek story I'm referring to has changed anything on the story with NVIDIA.
Well, I think that's a good question. I think it's something that all investors kind of have a close eye on. And we're kind of debating as we were kind of going into the print here. And as we expected, actually, Jensen was very bullish about the demand landscape in a post-DeepSeek environment. And essentially kind of talked about the belief for a lot of these kind of next generation reasoning models out there to require a lot more compute out there, as much as 100 times the amount of compute that you're seeing now from these kind of reasoning models. And essentially kind of his belief is there's this concept known as model distillation out there, which is what DeepSeek is essentially leveraging. And that's kind of basically taking a lot of the learnings from some of these larger language models out there and leveraging it in their own models. And that requires, again, on NVIDIA's side of things, they've said it requires a lot more compute than just pre-training alone. So they, again, talked up kind of a very positive story post DeepSeek. It remains to be seen exactly how this all plays out. I will say this, as far as these large language models are concerned, you essentially have this kind of race to the bottom at this point in time in terms of pricing. A lot of new competitors out there, China competitors coming out there. And that's going to kind of commoditize the large language model side of things. So that is going to have an impact in terms of AI monetization as far as large language models are concerned. And as a result of that, we think it's going to be more relevant for investors to start looking at the monetization from these AI agents out there, and eventually as you move to a physical AI world. So I think this is an evolving landscape out there. I think stay tuned. But as far as Jensen is concerned, post DeepSeek looks better, at least long term, for the compute, the evolution of compute.
And then there's the geopolitics. I think we have to talk a little bit about what the Trump administration is intending to do. Recently, we learned that the administration is sketching out tougher versions of U.S. semiconductor curbs for China. Do you think that that necessarily will negatively impact Nvidia and that narrative in a significant way?
If the Trump administration goes ahead and actually kind of implements, let's call it a more harsh stance on some of these kind of export restrictions, especially tied to GPUs, and I think kind of the fear out there is a potential all-out ban of these GPUs, and that would include, I guess, their most popular seller, which would be the H20 out in China. And if that were to happen, I mean, that potentially puts at risk as much as 10 to 15% of their revenue, which is tied in China, at least tied to kind of the data center side of things. So yeah, I mean, I think when you kind of think about the negative tilt or the kind of the bear case for Nvidia right now, the biggest near-term risk out there has to be the geopolitical landscape. So hopefully we get some kind of clarity on that here over the next couple of months, and hopefully the administration doesn't take that harsher stance out there. To be honest with you, if the administration was really kind of looking to take a harsh stance on China as far as chips is concerned, we would say, hey, listen, do an all-out ban on the semi-equipped side of things, which would kind of be more of kind of a table pounder out there than kind of banning some of these GPUs. But it is very possible that we kind of get an all-out ban on these GPUs, and that would be the risk out there for investors of Nvidia.
These are early days for the adoption of artificial intelligence, but can you give me a sense, and maybe it's too soon to call it a super cycle, where are we right now in terms of the cycle for AI? And give me your assessment on how valuations kind of factor into that at the moment.
Yeah, I mean, I think you're right. I think this is early days, and there's going to be a lot of volatility. I think there was some hope out there from some investors that this was going to be kind of up and to the right, and that's not going to be how this all plays out, right? In terms of the CapEx spend, in terms of the AI monetization of all of this. In terms of the CapEx cycle is concerned, as far as NVIDIA's GPUs are concerned, we're entering kind of year 3 of this upcycle. It really kind of started with the OpenAI Microsoft partnership in early calendar 2023. So, comparisons are obviously going to get a lot more difficult as the years go by. The question is, how far is the current kind of CapEx cycle going to go? Potentially could go 5-6 years. Historically, kind of CapEx cycles on the data center side of things last longer than I would say on the consumer side of things when we're talking about, kind of, cycles tied to PCs or smartphones or something like that. But it's important. It's impossible to really kind of tell how this all plays out. Macro obviously has a big role in all of this as well. But the AI monetization is really kind of where all eyes should be for investors at this point in time. It's take a look at Microsoft, take a look at what a company like Salesforce is going to do, what they have to say over the next couple of quarters and years as far as AI monetization is concerned, tied to AI agents out there. If we see kind of a strong ramp here going into the second half of calendar 25 into 26, that bodes well in terms of kind of the sentiment and enthusiasm in terms of some of the spend that we're seeing. If you don't see that AI monetization really kind of ramp up the way some out there are hoping for, there's a very good possibility that some of these hyperscalers maybe kind of level off some of the spend as we go into 2026. As far as valuations are concerned across the AI ecosystem, they've definitely kind of compressed here over the last kind of 9 to 12 months. Is kind of tech has kind of really been in this kind of flatline situation since the summer of last year. In fact, if you kind of look at Nvidia's valuation, trading about 25 times on our calendar 26 estimate, it's come down significantly over the last couple of quarters. You can also see that across other type of Mag 7 type names out there, whether it be a name like Microsoft trading about 26 times our calendar 26 estimate, and others out there. They're actually trading at discounts to historical levels. So it kind of tells you that there are investors out there that are kind of getting a little bit skittish about kind of this AI trade at the moment.
Yeah. Angelo, thank you so much for the analysis. Great stuff. Angelo Zino there. He is Vice President of Equity Research at CFRA, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So we were talking about Nvidia a moment ago. You know, this stock has been down this year on concern about the slowdown in spending, potentially from data center operators. Also, we have to bring into the story the breakthrough from that Chinese startup DeepSeek. The company's chatbots show that LLMs can be developed on the cheap, and that could reduce the need for Nvidia's powerful AI chips. But for the moment, let's turn our attention to Chinese tech stocks. They've been on a tear lately. Joining us now is Shuli Ren, Bloomberg Opinion Columnist. Shuli joins from our studios in Hong Kong. Shuli, it's always a pleasure. Thank you so much. How would you describe what's been happening with Chinese tech right now?
Well, DeepSeek really has changed the perception of Chinese investors. They do feel, going back, like we know that Hong Kong listed shares, mostly Chinese companies, right? They are deep value traps. After the Beijing's regulatory crackdowns on big tech and the whole property bubble burst, the Chinese shares are very cheap. But DeepSeek basically said that, China is not just a manufacturing powerhouse. It's also good with the software and digital stuff, right? Like DeepSeek does generative AI. And the people didn't really expect that a small unknown startup, even to the Chinese until a month ago, could do so well despite all the export controls. And that really fired up. And then what we are seeing is that, the tech stocks, the software companies, they're doing very, very well. And there is a sense that China can be a growth market again.
In the latest column that you authored for Bloomberg Opinion, you write that a Chinese alternative to the Magnificent Seven arrives. And I'm wondering whether you're really focused on a lot of these e-commerce names that we hear so much about, like Alibaba, Tencent.
Yes. One thing, though, is a lot of it is about positioning, like global asset managers positioning. Coming into this year, everyone is overweight on basically the big seven tech stocks, right? The so-called, the notion of U.S. exceptionalism. And everyone agrees that the U.S. stock market is overvalued simply because so much money has been coming in. And there is this genuine need to diversify. And now the question is, where do you diversify to, right? China tech stock is one story. Another story is European stocks. They have been doing quite well as well. And there is expectation that Donald Trump, however you like it politically or not, could propel peace over Ukraine, which means that it could be good for European economies, especially Germany.
Beijing seems to have kind of changed its attitude where some of the big tech stories in China are concerned. I'm thinking back to the meeting a few weeks ago that Xi Jinping had with some of the leaders of these big companies, and I'm thinking of Jack Ma in particular. Yeah. Has Xi Jinping changed his attitude when it comes to big tech?
He has to, because believe it or not, just because China's economic outlook is not so good, right? Like the big tech, the big e-commerce platforms, political fortunes actually are improving because they actually soak up a lot of employment, right? Like young people, the unemployment rate for young people in China is very high. And if young people have no jobs, they could become delivery workers, unfortunately. Or like they could be Uber drivers in China, that would be Didi. Or they could set up a small e-commerce shops selling stuff. Or they could be influencers. And I think Beijing does recognize that these big platforms, they are job creators and they need to be nice to them.
When you look at valuation, you're a financial analyst by training. What do you see when you look at some of these companies, Chinese firms that trade in Hong Kong?
Everything is relative. I mean, Tesla trades at over 100 times forward earnings. Xiaomi and the BYD, they both do EVs. They trade at roughly 40 and 25 times. And relatively speaking, everyone else is cheap compared to Tesla, right? And it's not just that. A lot of Chinese feel that Elon Musk has been very distracted lately, and then that he's not paying attention to Tesla's business. And that opens a window for Chinese EV makers. And in fact, like a lot of EV makers, they are adding like a lot of like advanced technology. For instance, auto driving, greeting the drivers with their favorite songs, etc., for free. Like basically, you are getting the same car with technological add-ons, but you are not paying a penny more. And they do feel that the likes of Xiaomi and BYD have a lot of space in Europe or even in the U.S.
So I talked a moment ago about the rally that we have seen recently in a lot of these tech shares in Hong Kong. Do you know whether or not most of this buying is on the part of institutions, or is it the retail crowd that is really stepping up and taking smaller positions?
I think it's both, but most of it is still Chinese money. You can actually see, so basically mainland China and Hong Kong has a stock connect. Mainland investors can, through this stock connect, buy Hong Kong listed shares. And you do see that, whenever the Hong Kong stock market is wobbling, like you actually see the southbound money coming into Hong Kong. So I do think like there is retail money, there is institutional money, but most of it is still Chinese money. I mean, after all, like China has been a big career risk for a lot of global asset managers. They're interested, but they are still sitting on the sidelines. Although, if you see like macro funds or hedge funds, they are in and out. They do trade.
So how would you evaluate the conviction? Is there a feeling here that this is something more than a one-off, that there is really something more durable underneath the surface?
The last week or so, I have checked with a lot of asset managers. They feel quite bullish. And I do think DeepSeek is changing the game, right? Like going back to the whole thing. People have a lot of confidence in China's manufacturing power, but they don't really have that much confidence in China's software power. And the DeepSeek shows otherwise. And that's why, like, if you see the Hong Kong listed tech stocks, they wobble a little bit when the news flow comes that Trump is going to increase export chip controls on China. But very quickly, you just see people buy on the dip because they just think export controls are not working.
Shuli, thank you so much for joining us. It's always a pleasure. Shuli Ren, she is Bloomberg Opinion Columnist, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.